You see the stock price. It was $100 a month ago. Today it's 50. The thought flashes through your mind, a spark of pure, unadulterated opportunity. It's on sale, you whisper to yourself. A 50% discount. The urge to buy is overwhelming. It feels like finding a gold coin on the sidewalk. You believe you are being clever, acting decisively while others are panicking. So you buy, and you feel a sense of smug satisfaction. Then, the next week, the stock is at 40. Your satisfaction evaporates, replaced by a cold knot in your stomach. You tell yourself, "It's even cheaper now. I should buy more to lower my average cost." This is the logic of the hopeful. You are now anchored not to the opportunity, but to the mistake. Soon the stock is at 30. The cold knot has become a suffocating dread. You are no longer a clever speculator. You are a prisoner, chained to a sinking ship, and the only thing you hear is the sound of the water rising. This is the siren song of too low, and it has led more traders to financial ruin than almost any other single mistake in the book. The human mind is not built for the abstract battlefield of the stock market. It is a tool for survival in the physical world, a world of tangible cause and effect. In that world, if a valuable item is offered at half its usual price, it is almost always a bargain. We are conditioned by a lifetime of experience to recognize this pattern. We see a sale at a store and our instincts tell us to buy. The market, however, is not a retail store. It is a forward-looking discounting mechanism, a collective consciousness that is constantly processing all known information and, more importantly, all future probabilities. When a stock's price is cut in half, the market is not offering you a discount. It is sending you a message. It is screaming that something is fundamentally, perhaps terminally, wrong with the underlying business. The crowd, in its infinite but often slow-moving wisdom, has reevaluated the company's future earning power and found it wanting. Your desire to buy that falling stock is rooted in several deep-seated cognitive biases. The first, as I mentioned, is anchoring. Your brain is latched onto the old price of $100 as the correct price. Every dollar it falls below that anchor seems like a gain for you, a gift. But that anchor is an illusion. It is a ghost of a past valuation that is no longer relevant. The market has moved on, but you have not. The second bias is a profound need for ego gratification. There is nothing a novice trader wants more than to be the one who perfectly timed the bottom. To be the hero who waded into the river of fear and plucked the gem from the riverbed while everyone else fled. This desire to be a market savant, to outsmart the collective, is a form of vanity. And vanity has no place in this business. The market has a unique and brutal way of humbling the vain. It will let you catch that falling knife just long enough for you to feel the steel before it cuts you to the bone. The belief that a stock that has fallen significantly cannot fall further is a catastrophic misunderstanding of mathematics and market dynamics. A stock that falls 50% from $100 to $50 has not used up its potential for decline. For you to lose all your money, it only has to fall another $50. However, a stock that falls 90% from $100 to $10 still has the capacity to lose another 100% of your remaining capital by going from 10 to 0. The percentages are deceptive. The lower a stock goes, the more volatile it can become, the less institutional support it has, and the more likely it is to be in a death spiral from which it will not recover. You are not buying value. You are buying a statistical probability of further loss. The line of least resistance is pointing straight down, and you are trying to stand in front of it like a man trying to stop a freight train with his bare hands. You will not stop the train. The train will simply pass through you. Let me tell you a story not of stocks, but of a commodity. Cotton. In the early days, I made a fortune and lost it several times over. One of those times, the lesson was seared into my very soul. I'd been bullish on cotton and had profited handsomely as it rose. Then the market turned. The tape began to tell a different story. The price started to fall. At first I was unconcerned. I had seen pullbacks before. But this was different. It wasn't a healthy correction, it was a persistent, grinding decline. Every day it opened lower or sold off from the open. My profits began to erode. My mind, clinging to my earlier success, told me, cotton is too low. It was just at this price a few months ago. It must rally back. So I held. I even bought more. I was averaging down, a strategy that is the financial equivalent of doubling your bet on a losing hand in poker. I ignored what the market action was telling me and listened instead to what I hoped it would do. The price of cotton did not care about my hopes. It did not know or care that I thought it was too low. It simply continued to follow the path of least resistance, which was downward. I would watch the ticker, my stomach in knots as it printed number after number, each one lower than the last. I was paralyzed by a mixture of hope and fear. Hope that the next tick would be the bottom, and fear of crystallizing a massive loss by selling. My capital dwindled, my confidence shattered. Finally, when the pain became unbearable, when my account was on the brink of a blow-up, I was forced to liquidate. I sold everything. And of course, a day or two later, cotton staged a minor rally, just enough to mock me, to make me question my decision. But that rally was a phantom. The primary trend was still down, and after that brief gasp of air, it continued its relentless plunge to prices I could not have imagined. I learned then, in the most painful way possible, that too low is a judgment made by the observer, not a fact dictated by the market. The market is the ultimate arbiter of price, and its judgment is final. Arguing with it is an exercise in futility and financial self-destruction. Jesse Livermore, or Larry Livingston as he was known in print, consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk a dollar of your own capital. To ensure this timeless wisdom translates accurately to the modern computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. I teach you the psychology of the tape, the internal discipline required to face the market's endless challenges. My lessons are about mastering yourself, because until you do, you cannot master the game. But self-mastery is only half of the equation. You must also have a clear, objective method for reading the market's intentions. I give you the discipline and the mindset, but for the precise mechanics, exactly where, how, and when to execute the trade, you need the structure of Richard Wyckoff. He was a contemporary of mine, another titan who dedicated his life to codifying the behavior of the large interests, the composite man who truly moves the market. Wyckoff developed a practical, repeatable methodology for identifying accumulation and distribution, for seeing when a stock is being gathered by strong hands or dumped by the informed. His work is the perfect complement to my own philosophy. I've left the link to his channel in the description below. Use it to complete your arsenal. Do not neglect the mechanics while you are mastering the mind. So how does this fatal flaw manifest on your screens today? Consider the steel industry. Imagine a large, established steel manufacturer. For years, it was a pillar of the economy, a blue-chip stock in every portfolio. But then, things change. New, cheaper foreign competition enters the market. New technologies make some of their older mills obsolete. Demand for their specific type of steel begins to wane due to shifts in construction or automotive design. The company's earnings reports begin to miss expectations. At first, the stock drops from, let's say, $80 to $70. The crowd says it's a buying opportunity. The television analysts talk about its historical strength. Then it falls to 60. The company announces cost-cutting measures, but the revenue problem persists. It hits 50. Now the dividend is in jeopardy. The headlines are all negative. This is the point where the value argument becomes deafening. Look at its book value. Look at its assets. It's trading for less than the company is worth. Uninformed traders rush in, believing they are smarter than the market. They see a low price. I see a symptom of a terminal illness. The chart of such a stock tells a story of relentless pressure. You don't need to see it. You can feel it. Imagine a staircase leading down into a dark basement. Each step down is a sharp price decline. Each flat landing is a period of temporary support, a brief pause where hopeful buyers try to hold the line. But the selling pressure is too great. The weight of the downtrend is immense. After a few days or weeks on that landing, you hear a creak, and then the wood splinters. The price breaks through that support level and falls down to the next step. This pattern repeats. A sharp drop, a pause, another sharp drop. These pauses, these bear market rallies, are incredibly deceptive. They are designed to lure in the hopeful, to transfer shares from the knowledgeable sellers to the uninformed buyers. The novice sees a 10% bounce off the lows and thinks, "This is it. The bottom is in." He buys only to watch in horror as the stock rolls over and makes a new, more profound low, leaving him trapped at a higher price. The correct action in this scenario is one of supreme patience. Your job is not to guess where the bottom is. Your job is to wait for the market to prove to you unequivocally that the bottom has been formed. What does that proof look like? It is not a price. It is a behavior. First, the downward momentum must cease. The violent drops must stop. The stock stops making lower lows. Instead of a staircase down, the price action begins to move sideways, carving out a long, often tedious range. This is the first sign that the character of the market is changing. The sellers are becoming exhausted. The supply of stock being thrown onto the market is finally being absorbed without driving the price significantly lower. During this basing period, you must watch the volume. Volume is the footprint of money. In a healthy base, you will often see volume diminish. The action becomes quiet, dull. The stock may disappear from the headlines. This is good. It means the emotional, panicky public has sold out and moved on. Then you look for subtle signs of strength within that base. You might see small rallies on days with higher than average volume, and small pullbacks on very light volume. This suggests that intelligent money is quietly accumulating shares, buying on the dips, and is not yet ready to show its hand. This process can take months, sometimes even years. The bigger the decline, the longer the base required to repair the damage. Your only job during this time is to watch, to wait, to be a spectator. The temptation to act will be strong, but you must resist. The signal to buy is not the low price at the bottom of the base. The signal is the breakout. It is the moment the stock finally moves up and out of that long period of consolidation. It should happen on a dramatic increase in volume, a surge of demand so powerful that it overwhelms any remaining sellers. This is the market telling you that the long war between buyers and sellers is over, and the buyers have won. The line of least resistance has finally, definitively turned from down to sideways and now to up. Now, and only now, is it safe to consider a purchase. You did not buy at the absolute bottom. You will have missed the first 10 or 15% of the move. And that is perfectly acceptable. You have sacrificed the vanity of picking the bottom for the security of a confirmed trend change. You are not a hero. You are a professional. You are joining a move that has already proven its strength. You are aligning yourself with the dominant force, not fighting it. Now let's consider the scenario where you have already made this mistake. You are currently holding a stock that you bought because it looked too low, and it has since moved even lower. You are sitting on a painful open loss. What do? The first step is to discard all hope and ego. Your hope that it will come back is not a strategy. Your ego's refusal to admit a mistake is your worst enemy. You must look at the situation with the cold, detached eyes of a surgeon. Ask yourself one question. Knowing what I know now, would I buy this stock today? If the answer is anything other than a resounding yes, then you must sell. You must sell immediately. The pain of taking the loss will be sharp, but it is a clean pain. It is the pain of amputation that saves the patient's life. The alternative is the slow, agonizing pain of financial gangrene, where you watch your capital decay day after day, week after week. The money you free up by selling that loser is your working capital. It is your ammunition. It makes no sense to have your ammunition tied up in a losing campaign, a failed position. That capital should be in cash, on the sidelines, waiting for a true opportunity to present itself, an opportunity that meets the strict criteria of a confirmed trend, not the flimsy hope of a cheap price. Every day you hold a losing position that is in a clear downtrend, you are making an active decision to remain wrong. You are choosing to let the market punish you. Discipline demands that you end the punishment, accept the lesson, and preserve your capital to fight another day. Your first loss is often your best loss. The market does not owe you a recovery. A stock that was once at $100 has no memory of that price and no obligation to return to it. The market is a dynamic, ever-changing environment. Companies that were once leaders can become laggards. Industries that once defined the economy can be rendered obsolete. Your loyalty should not be to a stock, but to your own rules and to the preservation of your capital. The idea that a stock is too low is an emotional opinion, and the market is a brutal destroyer of opinions. It deals only in facts, and the primary fact is the current price and its direction. Therefore, you must remove the phrases too low and too high from your vocabulary. They are meaningless. They are the amateur's crutch. Instead, train yourself to think in terms of trend and momentum. Is the stock in a defined uptrend, making a series of higher highs and higher lows? Or is it in a defined downtrend, making a series of lower highs and lower lows? Is it in a sideways consolidation phase, building a cause for a future move? These are the only questions that matter. The price itself in isolation is just a number. It is the behavior of the price over time, the story told by the tape that contains all the wisdom you need. Do not try to be a bargain hunter, be a trend follower. Bargain hunters go broke trying to guess the bottom. Trend followers build fortunes by riding the great waves of market movement, both up and down. The choice is yours. Stay disciplined.